Disclaimer. In the first 60 days of this year, nearly 800 tons of silver left the global market and disappeared into one country, not spread across dozens of nations, not absorbed gradually over months. One country, 60 days, 800 tons, and the vaults that used to hold the world's silver reserves are bleeding metal at a pace that has no modern precedent. What you are about to hear is not speculation. It is not opinion. It is a sequence of confirmed, documented events unfolding right now in March of 2026, and almost nobody is connecting the pieces. By the time this story reaches mainstream headlines, the window may already be closed. Welcome to AG John OG. If you are new here, take a second and subscribe because what we cover on this channel consistently lands months before the crowd catches on. Now here is what I need from you before we go any further. After you watch this, drop one word in the comments. Just one. Tell me whether you think silver is headed for a breakout or a breakdown. One word. Breakout or breakdown. I will explain at the end of this video why your answer might reveal more about the market than any chart ever could. Let me take you back to the final week of December 2025, the holiday period. Markets were quiet. Most traders had already logged off for the year, and buried inside a routine bureaucratic announcement from China's Ministry of Commerce was a document that, on the surface, looked like paperwork. It named 44 companies. Just 44. These were the only entities in all of China that would be permitted to export silver beginning January 1st, 2026. Not a ban, not technically, but a licensing regime so tight that it functionally strangled the exit doors. Tungsten got the same treatment, antimony too. But silver, the metal that conducts electricity better than any element on the periodic table, the metal soldered into every solar panel, woven into every advanced circuit board, essential to the electric vehicle revolution, that metal just had its export arteries narrowed to a pinhole. And when Elon Musk saw the news circulating on X, he posted 5 words that ricocheted across financial media. Quote, "This is not good. Silver is needed in many industrial processes." End quote. Now, when the richest person on the planet, a man who runs the largest electric vehicle company on Earth, a company whose supply chain literally depends on silver, when that person publicly flags a supply concern, you do not need a PhD in economics to understand the gravity. But what happened next is where the story turns from interesting to genuinely alarming. January arrived, and instead of restricting outflows, China did something that caught even veteran commodity analysts off guard. It started importing silver at a ferocious pace. In January and February of 2026 combined, China imported over 790 metric tons of silver. February alone shattered records, with nearly 470 tons entering the country in a single month, the highest monthly import figure in 8 years. Think about what that means. China tightened the rules on silver leaving the country, while simultaneously vacuuming silver from every available source outside its borders. That is not contradictory behavior. That is strategy. That is a nation building a stockpile while slamming the door behind it. And where was this silver coming from? London. The London Bullion Market Association, the LBMA, operates the largest network of precious metals vaults on the planet. For decades, London has been the gravitational center of the global silver trade, but in 2026, those vaults have been hemorrhaging metal. In a single week in late February, London silver vaults lost 468 metric tons. Let me put that in perspective. The entire world mines roughly 26,000 tons of silver per year. London lost nearly 2% of annual global mine supply in 7 days. The free float, the silver in London vaults not already locked up in ETFs, dropped to just 197 million ounces by early March. That number is shrinking every week. Now let me ask you something. If you owned a warehouse full of a critical industrial metal, and you watched a single buyer drain your shelves faster than you could restock them, what would you do? You would raise the price. You would limit access. You would start asking questions about who is buying and why. And that is exactly what the market is doing, except it is doing it too slowly, because the paper market, the world of futures contracts and leveraged bets, has been masking the severity of what is happening in the physical world. Here is the number that should keep traders awake at night. By late February 2026, registered silver at the Comex, and registered means the metal actually tagged and available for delivery against futures contracts, had fallen to approximately 86 million ounces. That is a 31% decline in just a few months. In the first week of January alone, Comex warehouses experienced a 33.45 million ounce withdrawal in 7 days. That single week represented 26% of total registered inventory. On one particular day in January, 3.25 million ounces walked out the door with 0 ounces coming in. 0. By mid-March, the bleeding continued, with another 40 million ounces vanishing in a 30-day window. So you have London draining, Comex draining, Shanghai paying a premium of anywhere between 4 and 12% above Western spot prices for most of this year, with spikes as high as 29% in early February. The arbitrage mechanism that governed global silver pricing for 40 years has fractured. Lease rates, the cost of borrowing physical silver, hit 40% annualized. That is not a functioning market. That is a market under siege. And here is the part that no one seems to be talking about loudly enough. The Silver Institute, the foremost authority on global silver data, projects that 2026 will be the 6th consecutive year of structural market deficit. The 6th, total global supply is forecast to rise just 1.5% to about 1.05 billion ounces, a decade high, yes, but still not enough. Still, the projected shortfall is 67 million ounces. Some analysts put the real number closer to 245 million ounces when you account for unreported industrial stockpiling and strategic government reserves. 6 consecutive years of deficit means the world has been consuming more silver than it produces for half a decade. Every year, the gap gets filled by pulling metal out of vaults, out of ETFs, out of stored reserves. But those reserves are not infinite. They are not even close to sufficient if this pace continues. Now let me introduce a wrinkle that makes this entire situation even more complex. The solar industry. Silver is the backbone of photovoltaic cell production. The conductive paste that turns sunlight into electricity relies on silver's unmatched conductivity. In recent years, solar panels consumed roughly 196 million troy ounces annually, about 17% of total silver demand. China dominates global solar panel manufacturing, so China needs silver for its own solar build-out, which is the largest on Earth, while simultaneously absorbing silver from international markets. The solar industry is now scrambling to reduce its silver dependency, experimenting with copper-based alternatives and thinner silver layers, but substitution takes years to scale, and the current generation of high-efficiency panels still requires significant silver content. The pressure is not going away this quarter. It is not going away this year. So we arrive at the question that matters: what is China actually doing? One interpretation is purely industrial. China's economy, despite its well-documented challenges in real estate and consumer spending, is doubling down on advanced manufacturing, green energy, and technology exports. Silver is essential to all three. Importing aggressively while restricting exports is simply smart supply chain management for a nation that wants to dominate the industries of the future. But there is a second interpretation, and this one is harder to dismiss than it used to be. Central banks around the world have been accumulating gold at historic rates for 3 consecutive years. China's own gold reserves have surged. And in a world where trust in dollar-denominated financial instruments is quietly eroding, where BRICS nations are actively building alternative settlement mechanisms, the strategic accumulation of a monetary metal that also happens to be the most industrially critical metal on the periodic table starts to look less like purchasing and more like positioning. Silver has been money for 5,000 years. It is simultaneously the most conductive, the most reflective, and the most thermally efficient metal known to science. And right now, one nation is cornering the physical supply while the rest of the world trades paper contracts backed by metal that may not actually be sitting in the vaults anymore. The gold-to-silver ratio tells an interesting story here. It has fluctuated dramatically in 2026, touching the low 50s in some readings before snapping back above 66 in mid-March during a broad commodity sell-off. The long-term historical average sits closer to 40 or 50. JP Morgan projects silver averaging $81 per ounce this year. Bank of America's Michael Widmer has laid out scenarios ranging from $135 to $309 per ounce before the year is over. Silver touched a nominal all-time high above $121 in early 2026 before a violent correction brought it back to the $70 range where it sits today. That correction, by the way, happened on a single Friday in late January when the COMEX saw margin hikes and a 30% price smash in hours. Shanghai barely flinched. The disconnect between paper prices set in New York and physical prices paid in Shanghai has become the single most important fault line in the global silver market. Let me leave you with this thought. In every commodity squeeze in history, from oil in the 1970s to palladium in 2001 to nickel in 2022, the pattern is identical. Inventories decline quietly for months or years while paper markets insist everything is fine. Then a single catalyst, a delivery failure, a geopolitical shock, a sudden demand spike, exposes the gap between what the market promises and what the vaults actually contain. And the repricing is never gradual. It is violent, it is disorderly, and it punishes everyone who assumed the paper price was the real price. We may be watching that exact setup unfold in silver right now, or we may be watching a temporary supply imbalance that resolves itself by summer. The honest answer is that nobody knows for certain, but the data does not lie. 800 tons imported by China in 60 days, London vaults draining at record pace, Comex registered stocks down 31%, 6 consecutive years of global deficit, lease rates at 40%, Shanghai premiums stubbornly above Western benchmarks. These are not opinions, these are numbers, and they are all pointing in the same direction. So here is what I want from you. Go to the comments and tell me that one word, breakout or breakdown. And if you are feeling generous with your reasoning, tell me why. Because the most valuable thing about this community is not my analysis. It is the collective intelligence of people who are actually paying attention when the rest of the world is asleep. And if this video gave you even one insight you had not considered before, do me one favor. Hit that subscribe button. We are building something here, a community that sees around corners, and I want you to be part of it. I will see you in the next one. This content is for informational and entertainment purposes only and does not constitute financial, investment, or trading advice. Silver and all commodities carry significant risk, including the potential for total loss of capital. Always conduct your own research and consult a licensed financial professional before making any investment decisions. Past performance is not indicative of future results.